Good morning, everyone. My name is Eloise Hall, Head of National Accounts at Kensington Mortgages, and welcome to our latest webinar. Today, we will be asking industry experts for their insights into if they think the mortgage landscape is improving for brokers. Before we get into the agenda of the day, I'll just run through some brief housekeeping tips for you. So on screen, you will see an option to submit questions throughout today's session, and my expert colleague will be on hand behind the scenes to answer these for you. If you do have any tech issues, please do utilise the same question box and we will be on hand to help. We're expecting to run to around 45 minutes this morning, and your CPD certificates will reflect this. They'll be emailed out to you after today's session, so keep an eye on your inbox. But to make sure I keep to time, let's get started with the day. So having a look at the agenda, we can see we've got a great lineup planned for you. First up, we'll be joined by Kensington's very own CFO, Simon Betteridge, who'll be discussing the latest market trends and insights into how the landscape has been changing for brokers. We will then be moving on to our Voice of the Broker session, where Robert Sinclair will be answering your questions in a Q&A with our Head of Intermediary Partnerships for both Barclays and Kensington, Francis Cassidy. And lastly, I'll give you an insight into what we've been doing here at Kensington and what we're doing to continue to support you and our intermediary partners. So without further ado, let me please welcome Simon Betteridge, Chief Financial Officer at Kensington. Over to you, Simon.
Thanks, Eloise, and morning, everyone. Great to be able to speak to you all today, and thanks for joining the session. I thought I'd use this time to give an update on what we're seeing from a macro perspective, and what we think that means for both the mortgage market and for brokers and for customers. I'd start by saying that the environment is generally looking a lot more positive than it has done for a while. I've got quite a few charts on this page, but I'll probably start with swap rates, which are obviously a huge focus when it comes to mortgage pricing. And I think there's a few sort of key points to call out in terms of where we are now from a swap rate perspective. One of the things that we've seen as we've sort of moved through this year is that swap rates have been a lot more stable. What that means is that the outlook for base rate is a bit more predictable. We're starting to see 2- and 5-year swap rates as well converge. What those things mean is that reduced volatility in terms of swap rates, less variation in terms of mortgage pricing, and that is obviously good for everybody. Good for customers because there's more certainty, less rework for brokers around rebooking activity, with people wanting to get the lowest rates for their mortgage, and obviously less rework for lenders as well, in terms of rates moving around so regularly and by so much. What that means is that reduced volatility should really translate through to brokers having more time to try and acquire new business rather than spending time on rebooking of rates, which is obviously a good place to be. It's not just swap rates either that we focus on within the mortgage market. Obviously, base rate is a key part of it as well. Trackers are linked to base rate, but also I think a more important metric is affordability. So most lenders in some way have their affordability calculations linked to base rate. With base rates starting to reduce, obviously we'll get sort of the double whammy of rates coming down, but also affordability improving. So the maximum lending typically that lenders will provide to customers should start to increase as that base rate comes down, which is obviously going to give us a tailwind too, as we see rates reduce. Sort of looking a little bit more broadly as well, the other things that give me confidence in that improving outlook are HPI. So we can see that on the page. HPI has now been pretty sort of consistently either slightly positive or flat for almost a year. We're showing the seasonally adjusted numbers on the page. Actually, if it's unseasonally adjusted, I think it's positive over that period. So HPI is in a reasonable place and on a good trajectory. Obviously, inflation's dropped to broadly to 2% target, which is good. One of the metrics that I really like to focus on is the number of homes coming to market, because I think that just gives a signal for demand and supply in the market. And I think as we see more properties come to market, you typically see more buyers as well come to market, and it starts to become more of a buyer's market. That's now at a 7-year high, which I think is a really positive metric moving into next year. One of the items not on the page, but also is in a really good place, is consumer confidence. So consumer confidence is also starting to increase. What that does is point to a willingness of consumers to spend, to invest, to make those bigger purchases. And the recent increases we've seen in consumer confidence really starting to point to increased consumer spending over the next period, which again sort of just shows those changing attitudes and people being more open to making those bigger purchases. I think all those things together, so reducing base rate, more stable swap rates, improving HPI, inflation broadly on target, really positive housing market in terms of properties available for sale, really giving us all the ingredients for a strong market moving into 25. So really positive on that. If we move over to the next page, we can also see some of those things starting to play out in terms of what we're seeing now in the market. So first chart shows the mix of purchase business in the market. What we've seen this year is that purchase has really been the driving force behind the increased market that we've seen year on year. We've not seen that remortgage market really increase. It still remains relatively muted. And the chart on the right sort of shows that the market has grown year on year, but it's more due to consistency in terms of the size of the market rather than a big growth on what we saw previously. And that consistency in the size of the market, given that year on year growth, a lot of that is down to those stable swap rates. So last year we saw a lot of volatility in swap rates. They particularly increased over the summer, and you see that direct correlation to the market reducing at the same time as rates go up. What we've seen this year is rates have generally edged down, but been a lot more consistent. So moving around within a much narrower corridor, whereas previously we were seeing quite big increases, quite big decreases. So that stability has really helped create a sort of slightly larger but more consistent market. And like I said, driven by purchase. When we start to look forward into next year, and when I think about where I think the market is going to go and create opportunities, I definitely think remortgage activity is going to be the piece that sort of gives the market more momentum next year. So fully expect purchase activity to remain, strong and remain a really sort of powerful part of the market. But I do expect that remortgage segment of the market to start to heat up, particularly as customers start to move off of the higher sort of peak post mini budget rates, and equally as the overall property market gets hotter, start to wander around where they've locked in sort of higher rates for 5 years, whether it starts to make sense to actually look to break some of those 5-year deals to both secure a lower rate, but also take advantage of that broader market that's out there. So I think purchase will remain strong, remortgage activity likely to start really to heat up as we go into next year. And then what we see on the bottom left is total mortgage market stock. And what we've seen there is last year market reduced. We were expecting, or sort of press were expecting HPI to be declining, customers really suffering through cost of living, interest rates obviously accelerated pretty quickly. All that meant that customers were paying down debt, reducing overall market, and probably a little bit of nervousness around where the housing market and property prices were going to go. Obviously, we've touched on now it's a much more positive position. And what we've seen as we have gone through the first half of this year is actually the total market has moved back to growth. So it declined last year. We've seen the total market grow about 10 billion in the first half of this year. You'd broadly expect that to continue in the second half. So 20 million-ish growth for the year broadly. But what we see if we look back a little bit further, is typically the mortgage market grows year on year by about 40 or 50 billion. So although the market seems to have turned a corner and we are starting to get growth back overall, there's still sort of more runway to go in terms of growth. And I definitely expect that's the trajectory that we'll start to see as we move into next year, which is more of that sort of longer term trend growth. So 40 or 50 billion growth in the market rather than sort of the muted growth we're still seeing come through. What that means for Kensington and for Barclays as well is that we're really positive around the outlook for the mortgage market. And we absolutely see it as a place that we want to grow our presence, support brokers, and do more business together. I think sort of on the bottom right of the page, we're trying to call out some of those macro risks, which do still remain. But I think as long as the government and the economy can sort of navigate through some of those residual risks that are still out there, I think sort of no news is good news, i.e. that we can continue on the sort of trajectory and with the momentum that we've got now. I think that puts us in a great place from a market, from business perspective, to have a really strong end to 2024 and carry a lot of momentum into 2025. So as I said, I think really positive outlook in terms of where we think the market's going to go. Really positive in terms of mortgage market's a place where Kensington particularly are looking to grow and to take advantage of those positive market conditions. Yeah, I think you know, it's great to be in this position, particularly after what's been a fairly challenging period, I think, for most. So hope everybody found that helpful, informative. Happy to receive any questions on any of that. Thanks again for joining, and I'll pass back to Eloise.
Thank you very much, Simon. Great to see the numbers behind the market there. The word of the session definitely seemed to be stability, and we've experienced quite volatile markets for the last number of years. And we saw from Simon's data that this had a negative effect on overall consumer confidence. And we of course know how impactful that can be to our markets and our industry. So to have a more stable market is an absolute positive. And the question that we're asking today is the landscape improving for brokers? And the figures around household stock and consumer confidence paint a great picture. The good news is we have more activity and households feel more confident to move with enough house price inflation and buyer demand to support sales volumes. In more good news, Simon mentioned the recent reduction in Bank of England base rates, which has meant lenders can make positive changes to affordability. And in less than a month from now, on the 7th of November, we have the next MPC base rate meeting, the penultimate one of the year. Many experts are forecasting we will see another reduction this year. Whether that's to be in November's or December's meeting is to be seen. But Simon also highlighted the positive trends that we've seen in swap rates as well. If we look back to this time 2 years ago, in fact, we saw one of the biggest spikes to swaps on record, but they are now in a much more stable place. Admittedly, last week we did see swaps tick up a little bit after Andrew Bailey's announcement, which hinted at expectations for larger or more frequent rate cuts. Although a very encouraging statement, we've since had conflicting comments from MPC members cautioning that future voting behaviour. As of this morning, future forward 2-year swaps are recovering and back below the 4% mark. So it looks like a very positive end to 2024. And as Simon said, there's lots more runway for growth for the rest of this year and also into 2025. And 2025 will be a very important year for remortgage, with UK Finance predicting 1.8 million maturities expected next year. But we know that with remortgage comes a lot of PT, and income across your businesses may be impacted because of this. So looking at ways to diversify your business will be key next year as well. And one of the ways brokers can expand their business and potentially increase income revenue is through horizontal diversification, adding new products and services that are potentially related to existing ones, but appeal to different customer groups or segments. With growing cohorts of specialist customers and underserved segments in the mortgage market, there are plenty of opportunities for brokers to tap into. But next up, we are now very lucky to be joined by Robert Sinclair, CEO of the Association of Mortgage Intermediaries, for a Q&A session. Robert is often referred to as the voice of the broker in our industry, and we've put to him some of your questions, so thank you to those of you who have submitted a question to him. Francis and Robert caught up last week for this interview, so here's that video for you now.
Robert Sinclair, welcome. Thank you for joining me today.
Pleasure to be here and join the Kensington webinar series.
Brilliant, thank you. So the key question that we're seeking answers for today is the mortgage landscape improving for brokers? Any first thoughts?
It's kind of mixed, I think, is the way I would describe it. And it depends where you are in the country, I think. There's some pockets where there's a great deal of positivity, things are getting better. There's other parts where I think it's fairly static and stable. I think the biggest challenge firms have got is that they've seen their income probably falling from a mortgage perspective over the last 2 years. FCA data tends to indicate that firm income is down 10% from 22 to 23. Mm-hmm. We're expecting another 5% fall 23 to 24, which is challenging. Yeah. Good firms are backfilling that with more protection sales, but that doesn't fill all the gaps and doesn't make the mortgage market feel better. What I do believe is that Q4 will be better, but of course we won't see that flow through until 25 figures and 25 income. Therefore, I still think the rest of 24 is going to be challenging from an income perspective, but I think business will pick up.
Interesting. There's a few things you said there that I'm going to come back to actually. But firstly, I just wanted to talk a bit and highlight your amazing career in our industry. Most recently, 16 years at Amy, soon to retire. We'll come on to that again in a moment. The mortgage industry would have changed a lot in that tenure. I wanted to ask you how you think the role of a mortgage broker has evolved in that time.
If you go back to 16 years when I first moved into the trade body world, which was 2006, self-cert interest only was the predominant product of the day.
Popular choice.
And therefore, a lot of people were getting mortgages who probably or possibly didn't deserve the amount they were borrowing. Mm-hmm. The role of the broker was really just bolt the customer into the lender and hope for the best. And you could say that we were spraying something everywhere, but that's probably where we were. Mm-hmm. The role of the broker, or I prefer to call them the advisor now, is very much around trying to make sure that they meet all the regulatory rules which have been ramped up significantly, all the affordability rules that are much more complex, and the requirements of lenders. And the product landscape has moved significantly over that period. Mm-hmm. So the whole development of, and whilst there was subprime back in those days, it still wasn't a developed specialist audience in the same way. And if I think of the range of lenders and products that are now available, vastly different. And the advisor has to know a lot more, be a lot more aware. And of course, properties are more complex, people's incomes are more complex, people's lives are more complex. Absolutely. Therefore, all of that advice is more complex.
I love that you say advisor and not broker.
It's important to see this, and it's not wrong to think of it in those ways, because I think what you do see is a clear demarcation line between some firms who are very much in that transactional approach of hit one, move away, find another customer. Yeah. There are others who want to stay with that customer for their lifetime. Yeah. And both are right in their own way, as long as you're really clear about what you're trying to do, what to achieve, and really clear with the customer about what you're there to do. And I think it depends on the type of firm you want to be. And clearly, if you're in the new build world and servicing new build in that arena of working with a builder on site, it's very transactional. Yeah. If you're in that space where you're dealing with friends, family, the friend down the golf club, football club, rugby club, your family friends, you're in a very different non-transactional relationship, which is much more about relationship. Mm-hmm.
Robert, you're going to be leaving behind an amazing career history and legacy. What would you share as your biggest learning in your role and your tenure?
I think I grew up into work as quite an angry Scotsman. I'm probably still angry too often on occasions, as the regulator will refer to. I think I've probably learned to be kinder. I've probably learned that I can't do everything, and building a team around you and if you give them space, they will grow and actually really surprise you. Mm-hmm. And I think allowing and having faith in the people you recruit is something that's taken me a lot longer in my career to appreciate than it probably should have done. And it's quite important, I think, that people really think about, if you genuinely trust people that you've recruited to be the best they can be, then they will really surprise you. Yeah. I think that's probably one of the things I've learned the most around all of that.
I love that. That's good. And I was going to ask you what your biggest win was, and maybe your biggest win or your team's biggest win.
Oh, the biggest win is really easy. I mean, it's a long time ago now, but we went into battle on behalf of the mortgage and protection sector to take effectively protection sales, insurance sales out of being linked to pensions mis-selling. So under the Financial Service Compensation Scheme, they were bolted together. So effectively, mortgage advisors were going to be paying for a long time for all the pensions investment mis-selling scandals of the previous decade. Getting that moved out into the GI sector was a risk because we didn't quite know how PPI would land around all of that.
Yeah.
But our estimates are that has saved the sector £100 million.
Wow.
Since that happened.
That's a huge
Now, that is a huge win. And it wasn't in the first consultation. The first consultation that came out, it was they'd refused it. We went back in and talked to the FCA, and indeed, the person we actually ended up speaking to was Andrew Bailey, and got him to agree that it was the right thing to do. And they then, unusually, the next policy statement came out with a policy statement with a supplementary consultation that changed that and took more protection out of that. That was the single biggest win that I think any trade body's actually ever had with the regulator, because of the sheer cash shift. But it wasn't a zero-sum game. It saved mortgage and protection firms, but it moved all the costs back into investment firms, which was hard for them, but better for us.
Yeah, absolutely. Robert, I wanted to ask you, what do you see in really successful advisors? What do you think those skills are that really make those advisors stand out?
There's probably one word that exemplifies it, which is empathy. But I think it's about the skill to listen, the skill to ask good questions, and the skill to not accept at face value what the customer might be saying to us, what they want, but really getting under the skin and working out what they need. And that is the real skill of advising, is really understanding that and making sure that you will go that extra yard to make sure you've defined that whilst the customer might say that's what they want, their need may be different, because they might say they want the cheapest 2-year fix, but actually a 5-year fix that fits their lifestyle might be better. They might think, I think the hardest challenge is sometimes that challenge of somebody walking in thinking they can get that very cheap deal that's available in the marketplace, but actually their circumstances don't allow it. The skill is, how do you turn that customer around without them feeling that there's something wrong with them, that actually we can still help, we can still be in the right place, we can hold their hand and be all the way through that. So I think that's the real skill that makes a great advisor successful.
And I think we speak so much more and understand more about customer vulnerability now than we ever have before. So I think that really plays into what you're saying.
And vulnerability is difficult in our sector because actually, I look at the broad range of financial services, a lot of people have vulnerabilities. If you take people right across savings and current accounts and credit cards and motor finance, there'll be lots of vulnerabilities people have there. People who are borrowing on mortgage predominantly are turning up in full-time work, turn up for work every day and delivering. The vulnerabilities we'll have are much more liable to be things like difficulty reading or hearing difficulties, or a different way we need to communicate with them, or a language issue, not purely financial issues that we need to think about that are present in other parts of the marketplace.
Absolutely. So Robert, coming to the end of your tenure at Amy, successor is being recruited for and looked for at the moment. Any exclusive update you can give us on that?
That would be very wrong in terms of anybody that may be in the process. Confidentiality around all of that, I think, is always quite important. What I would say is that anybody who's looking to take on a role like this should really think about being themselves. I think if I look back at me and what I've done, I think the Amy job taught me about authenticity. And also confidentiality, the ability to talk to a whole lot of people and remember that if you have that genuine authenticity and confidentiality, you will get an awful lot of information that you can then use, but you must keep it in the box that says, I can't talk about where I've got that from. The Chatham House rule that says, you can talk about what's said, but not who said it or where it came from, is really, really important, and not attributing it to any particular individual firm. I think the other part is, I would say this to anybody, don't try to be me. Because that'd be a very stupid thing to do on every level. But also be yourself, but also think about the things that you genuinely want to be known for, because there are lots of things that are changing. And one of the reasons for stepping away now is that I was looking at this in terms of there are a number of issues that are coming on the horizon that are going to be a 5-year time frame in terms of how somebody understands them, works and develops frameworks to answer it. And there are 2 or 3 of these that are really big. I think technology and AI is big
Yeah.
and going to be a challenge for the industry, and I'm far too old and too antiquated to deal with all of that. I think the green agenda is going to be huge as to how we deal with retrofit and new build.
Yeah.
And I think the agenda for that is going to be complex and needs somebody who's going to run with that for a period of time. The D&I work is not finished, and there are big challenges coming out of the regulator, particularly in the protection market, that is going to be a 3 to 5 year cycle, is what needs somebody else to run with it, because I've reached that age where I'm not committing to working for another 3 to 5 years.
Yeah, absolutely. We'll come back to some of those points as well. Thank you. So we've heard from Simon Betteridge, our CFO, and earlier on in the webinar, and that was talking a lot around flattening of swaps and improving in the pricing market. It'd be great to cover some wider aspects of the market with you now. So let's start in technology and AI. What do you think brokers could be keeping an eye out for? And is there anything that you think's happening that may not progress in the future?
You're not making this easy, Francis, I have to say. But what I think the challenge for advice firms at the moment is really knowing where to go and what to do. There's a lot of tech offerings out there, but trying to pick the ones that will work for their business is really difficult. And what we often see is fragmented approaches where people want to bolt things into certain aspects, but how does that fit in holistic end-to-end customer journey? And for firms to make that decision is really difficult. So what they want is something where they can start with the customer inquiry and end up with a completion all in a single flow, not having to log in and out of multiple systems as they're going through this process. But it doesn't really exist at this moment in time. So I think the challenge any firm has is, if they're looking to change, what is the core bit they want to invest in or make a decision about that gives them the right answer? Now, it's not for me to make those judgments for firms, because there's lots of competing commercial enterprises out there trying to do this. But the one thing I always say to any firm is, look at what will cover the biggest part of the customer journey for you in the way that works for your business and your people. And there's lots of bits around, how do you get the customer data into a fact finder lending application? How do you get that suitability factor out there? How do you get the lending application out into the lenders that you're really interested in? I think that there's lots of people playing in all of those aspects. But then the last bit is, how does that broker firm allow customer access to all of that so they can see it? Because that's the really hardest bit of having that open architecture that allows everybody to see what's going on with the right security controls.
And there's so many options out there for brokers. There's so many different tech firms offering very similar offerings.
Yes, and the problem is that until you get right under the bonnet or technical specialists, knowing which one is better than the other, very difficult to understand.
Yeah, absolutely. So recently, something very close to my heart, we've seen a lot of consolidation and some acquisition within the market, particularly lenders, Barclays and Kensington being one of the more recent ones. What do you think that would have as an impact on brokers?
I think there's always the worry as what happens for those customers caught in legacy. So there's always that worry, what's going to happen there. I always look at this and tend not to probably get too concerned about it, because we have 6-8 lenders of scale that cover 80% of the market, and there's another 100 lenders chasing the other 20%. And there's always going to be fluidity in that. I think the challenge is making sure that the customer's protected in all of this and the advisor's protected in all of this, because there are some firms that come to market with great propositions that really help look after the advice firm. They might get acquired by another firm who don't think of advice firms in quite the same way. And so I worry about that to a degree. We've seen the supermarkets come to try and do all sorts of things and exit the market. We've seen other organizations. It's been interesting to see two of the bigger mutuals decide that actually acquiring other mutuals is probably too complicated, therefore actually going into the market and buying, acquiring the shares of two entities. And that's quite an interesting thing to look at in terms of structurally what's going on, how they acquire bigger scale. So I think the challenge is how, in a strongly regulated world, where things are getting more and more complex from a regulatory and capital perspective, and Basel 3.1 coming in makes that even more complicated for firms, how do you actually manage all of the costs of running a business in what is an incredibly more complex world? So the worry for me is always about, where does that leave the broker and the advisor and the customer in all of this? But you have to accept that the world continues to evolve, and you can't stop that evolution. It's good. And it's good that actually you think about an industry where firms arrive, are innovative, grow up, and somebody wants to acquire them. That's really positive. because actually it means they've generated a change in value that people think is beneficial.
And you said earlier about advisors and what advice they need to give in customer circumstances that are so different now than they potentially ever been before and so much more complex. Do you have opinion on kind of the specialist market and where you see that going?
Yeah, well, I think it's the fact that large organisations are looking at the big banks and the large building society, are they truly non-specialists now? Because everybody looks at a customer as being quite complicated, and I don't think we're in a space where you can genuinely just think every customer's vanilla and we'll go through and not touch the sites. Yes, there's still a proportion of those. We've got pretty straightforward P60 incomes, 2 kids, house I can tell from a survey is definitely going to be okay. If you've got complex employment contracts, multiple work, you've got more complicated house that doesn't fit on the grid, you're in some very, very different stuff, and that's a bigger and bigger proportion. You look at just the number of people who want to do self-build now. All of that is, and shared ownership will take us to another place, because this government is going to drive shared ownership forwards, and that's a good thing because it gives us different tenures, that we've got choices that are probably out of the landscape for the last decade. So we need to think about how we as a sector support all of that. It's really important from my perspective.
No, absolutely agree. So innovation is a hot topic with both Barclays and Kensington and most lenders at the moment. What do you think lenders need to focus on to support brokers?
It's an interesting one, Francis. I mean, innovation is always been a challenge for this industry, in that fundamentally you're giving somebody some money for a house and looking for different ways to get it paid back. The innovation tends to be more around how far up we'll do in the LTV or LTI curve in terms of innovation, or what maximum, or we're playing about with age groups now in terms of how late might we lend, or how is a 25-year mortgage the right number, because affordability means we have to press out to 30, 35, maybe 40 years. And we've got all the other stuff running around intergenerational wealth and transfer, and how do we put that together, whether it's joint or sole proprietor, or all those kind of things are flexing what is still a fairly standard contract, because the mortgage contract is relatively straightforward. And we play about with the criteria and the edges. And then you also see us playing about with, in an industry, with credit score, or what incomes we'll take, or all those kind of things are flexing the muscles of the industry to a degree. And it's an interesting one, because that flex is probably getting to quite interesting proportions if I look at this over a long-term cycle, because what tends to happen is all the things get drawn back when we get to a point of financial stress or repossessions, and we've not had that number for a very long time. Because we still get repossession data, very, very small, but it's when people get ill or have disharmony in their relationships. We've not had unemployment, and it's unemployment that really drives the risks. And I don't see any point in the economy going forward what unemployment's going to get. We went through cost of living crisis with an expectation that unemployment rate would go from 4 to 8%. They didn't go above 5, which is why we've not seen the kind of dislocation in property prices that gives firms comfort that they can still comfortably lend against all sorts of other criteria. Now, that flex is really important, but the key issue for firms is, where is your specialisation? And the clarity that Consumer Duty gives, or should give, is really understanding what it is your product does for which consumers. And brokers understanding which market are they trying to serve. So a broker should have clarity of, am I just going to play in first-time buyer? Am I going to be in standard resi? Do I want to work in areas where actually there might be credit repair or people who've got complex circumstances? And do they market themselves as such into those places? Because then they become specialists, and it might be they want to make sure they've got the right sourcing systems that work with specialists, as opposed to the standard resi stuff, which haven't got quite the same granularity around that. And you've got to build your business model around that. That is the modern regulatory expectation, which is really difficult, and it's a change in view about what are genuine good consumer outcomes built off the back of clarity of purpose for both lender and broker.
Absolutely. And how about kind of green new build? We have a large target to hit in the next year. How about innovation from lenders in that area specifically?
It's interesting to see where government thinks they're able to go. I'm challenged by the thought that says, if they're going to meet the £1.5 million house building target, it means in any number I look at, in 28 and 29, they've got to build 400,000 new homes. I can't see where the supply chains are, either by way of labour in the skills, or materials come for that. And they've just reconfirmed recently that they still expect the private rented sector to get to EPCC or better, and also the social housing sector to get to EPC or better by 2030. There are not the materials or the workforce to deliver that, in my view. Now, which means there's got to be some flex around some of this. The other part is what funding will come for government for those who can't afford.
Yes,
and that's the other part of this, that there's still, we've kind of got, I think we've kind of got the dot to dot where we've joined the dots, but we've still got no colour on the page at all in any of this. And government are going to have to give this blueprint, or regulators are. And until we get more of that, I think it's very hard for the industry to decide where they're going, either by way of funding those that are already green by way of greater lending or better affordability, or what we do for retrofit, because the retrofit journey is still complex for customers. And for a customer who decides they want to go there, making that decision of what they want to do to their property, then how they fund it, is very complex between unsecured, mortgage, or even lifetime, if they're in that part of the journey. Very complicated advice, very difficult to do, and not all people will be sitting in the space with all the product and competency to do that.
Absolutely. And do you see advice on sustainable housing becoming part of the process for an advisor?
I think it has to, because if I look at who is going to be the person the customer's going to ask, do I genuinely think estate agents are going to be tooled up and skilled enough to deliver this? I don't think so. The builder is going to have a vested interest in terms of this. The estate agent is going to have a vested interest in all of this. And we're seeing some models being built in some sectors at the moment where they're beginning to work out how they piece this journey together. But ultimately, the only person the customer is probably going to have this conversation with about, I'm thinking of doing this, how do I fund it, will end up being their mortgage advisor.
Absolutely.
And therefore, whether they want to or not, I think they're going to be sucked into it.
And do you think lenders play a role in kind of that education piece?
I hope so. I mean, I think all education around this is important. But I think delivering clarity of what it is you're trying to do by way of what you want. I think one of the big challenges every lender's going to have is, what shape of a book do they want going forward? And whether it's in the private rental sector space or the residential space, or even the social housing space, where I think there's going to be a lot more forcing by government in entities to fund that, and in private equity partnerships, perhaps with local authorities. I think the interesting part for me is the Burnham experiment in Manchester, which I think Labour Party are looking to replicate across other parts of the country. Not all of that will come from sovereign wealth funds as it has in Manchester. So we're going to have to find different funding models. And large organisations with big balance sheets, I think, will be encouraged to participate in that. And that's not a bad thing. It's how we energise the economy using the power of our domestic institutions.
Yeah, thank you. Thanks, that's a great answer. So Robert, your role at Amey has involved lobbying regulators and policymakers. What do you still think might be to come from the regulator?
I think consumer duty is probably the biggest single change from a regulatory perspective that there has ever been. I think people who haven't listened to the messages haven't understood exactly how game-changing it probably is. As we're beginning to see some stuff emanate now, particularly if I go and look at the work they've just produced in the general insurance market, the work they talk about in the pure protection market, and thinking of the market study now on pure protection, we're beginning to see a sea change when they begin to talk about what it is their expectations are. What is a good consumer outcome? Is a good consumer outcome the customer gets the mortgage that allows them to either acquire or keep their house at the cheapest price? I don't think so. The good consumer outcome has to be having the buildings and contents insurance wrapped around it to make sure that on the day they exchange, they're protected. A good consumer outcome might be, for certain firms or customers, having a fully protected mortgage with life, critical illness and income protection. Or are we genuinely thinking about our products in the right way? Because if we're building products and looking at the GI, the general insurance work, where the regulator's being to ask some fundamental question about product construction, is there enough dialogue in our marketplace that says, if you're building a product, if there is an ability to overpay, how many customers do it, and how much of cost is in that product for giving that facility? And if it's only used in a very isolated occasion, why is it there as a product feature? If we have, are we genuinely happy that our policy on early repayment charges fits with the model that works? And are we making profit off that or making losses? Because the regulator's really interested in that now. Have we thought about products in those types of ways? And do we as the broker advisor distribution market challenge enough of lenders about what those product features are and whether they actually work for the customer. Because I don't think we've ever had that really in-depth dialogue between the advice community and the manufacturing community about what a good consumer product or outcome genuinely is.
Absolutely.
And I would almost lay down a challenge that says, why has nobody thought about the fact that if you had a fully protected mortgage, that rate is not cheaper in the same way it might be cheaper effectively because it's more energy efficient. What is the difference if there's a fully protected mortgage? Because the outcome for the lender and the consumer is always safer. That's our argument about what the customer stopped paying. Well, yeah, the customer stopped doing lots of things.
Yeah.
That's an element of trust in this somewhere in this process.
Yeah, absolutely. Is this on your agenda for before you leave, Amy, or is this something you're going to hand the baton over for?
Oh, I think that's a baton handing. It's leaving the hand grenade with a pin in for my successor.
That's great. That's brilliant. Thank you. So, Robert, 16 years at Amy. Lots of remarkable things may have happened over this time, personally, for the market. Is there anything that really stands out for you?
I think the biggest shift for me has been when I started in this job, the lender and advice community were almost at loggerheads. Not fighting, but they weren't partners.
Yeah.
The biggest shift, then, I know I've worked hard at this, is how do we get that partnership that genuinely is about making sure that advice firms understand lenders' issues and lenders understand advice firms' issues, and working together for the benefit of the customer to get to the right outcome. That has been a passion for me about partnership. Is it all the way there with everybody? No. Do we occasionally fall out like good families do? Absolutely. And so we should, because a good relationship is where you can disagree and then still agree that you're still going to work really well together afterwards. Because that is the way that good dynamics work, where you can have these debates and discussions but still love each other afterwards.
Absolutely.
And I think that for me is the biggest transformation. But like everything, if you don't stop working at it, it will fester and die.
I think there's been huge progress in the past few years, definitely time that I've been in mortgages, and Amy and Imla have a brilliant relationship. And I think the relationships from direct brokers and the lenders are really getting there now as well. So good progress.
Yeah.
Well done.
It's a team. It's a team.
Absolutely. So, Robert, burning question. You'll be retiring very soon.
Yeah.
What is it that you're going to be doing with your time? Do you have anything slightly out there that you might want to achieve?
I intend to carry on as I already do as a non-exec at the Darlington Building Society. Although the travelling up and down of there is a challenge sometimes. I really enjoy being involved in a small regional mutual. It's a fascinating thing to do. And hopefully some other organisations might choose to ask me to do some work with them. If they do, it's great. If they don't, I will do other things. I want to go back to doing a little bit of golf, a little bit of watching cricket. There's one burning thing that I'd really like to try to do, which is a bit weird. As some people know, I was a lot younger, I was an athlete. I've kind of got this desire to go back and run 100 metres in under 13 seconds before I shuffle off this mortal coil.
Absolutely.
Whether my body will allow me to do it is a different thing entirely.
We've got some time to train.
Time to train.
Slow but sure. Well,
Possibly.
we'd be very happy to show the exclusive video of you completing that race.
And I might come for sponsorship.
Brilliant. Absolutely. Well, thank you so much, Rob, for joining us today. It's been really insightful. These webinars are all about our brokers and giving them as much information as we possibly can. So having the voice of the broker here has been absolutely brilliant. Thank you so much. And now we're going to hand back to Eloise.
Thank you.
Thank you very much, Robert, and thank you, Francis. A great insight into the history of the broker journey there, along with some great tips and focuses, including utilising different technologies and AI within your business. A great website that I've seen recently is there'sanaIforthat.com, which has a list of apps which could support your business in different ways, from automatically creating content for customers to improving business efficiencies. As Robert mentioned, there is an improving picture across the UK, with some pockets experiencing stability, and this is true in the lender space as well. Robert highlighted the changes we've seen in the lender space, including the acquisition of Kensington by Barclays Bank UK, allowing us to have a unique full market view of our industry, enabling us to better support more customers and more brokers in different ways across the UK. So thank you both for your time on that session. Lastly, moving on now to Kensington's mortgage update. At Kensington, keeping intermediaries at the heart of everything we do has been a key focus for us, and we continue to offer you excellent service. For the last 2.5 years, even throughout all of the market challenges, we've been able to provide you with a day one service on all new applications and documentation, whilst continuing to provide 48 hours notice on product withdrawals. We also continue to innovate in the market, so helping you say yes to more customers. You may recently have seen the launch of our mid LTVs, so challenging the status quo of offering LTVs in 5% bandings. We now offer a 92.5% LTV product, 87.5%, 82.5% rates also available as well. This allows better affordability for customers, as well as helping them actually pay for what they need rather than being fixed into these bandings. We have also launched a step down product, which offers a 5-year fixed term where the rate comes down after the first 2 years. We know some of your customers have a less than perfect credit profile, and these customers would benefit from the stability of a 5-year fixed term where the rate reduces throughout that time. We also have some excellent announcements on the horizon. Tomorrow you will receive an email, if you are registered with Kensington, of course, which confirms the launch of a new buy-to-let range, which will sit alongside our current buy-to-let proposition. So please keep your eyes peeled on your inbox for that. So thank you so much to all of our guests for joining me today. I hope all of you listening have found it just as interesting and informative as I have.